makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. A bellwether German state posts a surprise CPI jump in August, suggesting that the ECB may have more hikes ahead, while Spanish inflation quickens again. The latest U.S. jobs and consumer data offers support to investors, speculating that the Fed is nearing the end of its tightening campaign. Plus, UK property portal Zoopla says home sales are on track to drop to the lowest in over a decade. We'll bring you the latest mortgage data later this hour. So first thing is first, good morning. Happy Tuesday. Let's take a look at the European markets map. There's quite a lot going on actually across the board. And of course, I'm reminded that it was a bank holiday on Monday, so happy Wednesday. There you go. We're a day ahead of where we're expected to be. We have quite a lot of data, U.S. jobs on Friday. Now, the markets are looking at two things. First of all, this is the European map. European stocks are wavered a little bit, so they're still gaining a bit of support, but the bonds fell flat after the latest data suggesting that inflation may not yet be on the retreat in Germany. In fact, if you look at Germany's 10-year yield, it jumped 4 basis points after the consumer price index, which is in the bellwether state of North Rhine-Westphalia, rose in August. What this means is that the waters are a lot more muddied for European policymakers. Also, after in the U.S., we had a very different story. So let's also look at Treasury yields in the U.S. slumping to the lowest levels in more than a week. This is after the bigger than expected declines in gauges. Looking at job creation consumer confidence really prompted a bet on what bond traders did in terms of assigning lower odds that a Fed interest rate hike this year would happen. So that's the impact that it's had on the U.S. two-year yield. And then the other big story today, global stock bulls are back in the driver's seat. Now, this, without a doubt, is one of my favorites data points that we're looking at. And this is thanks to David Inglitz for putting this together. It's the Fear Greed Index, and it's back in positive territory. Now, a reminder to everyone that in traditional markets, the Fear and Greed Index measures investor sentiment based on factors including volatility, momentum, and demand. And so you can see there that they seem to be back. What that means going forward, usually September is a busy week anyway. Then we're getting more breaking news. So we had North Rhine-Westphalia. This is the bellwether state, but we're getting, week after or region after region in terms of what Germany has been seeing. So if you look at Bavaria, that August price is rising some 0.3%. Hesse August consumer price rising 0.2%. Again, the general feeling is that there is a bit of muddied water for what the ECB does next, because we were hoping that inflation was coming down, and actually it's not quite as clear-cut as expected. The other piece of breaking news is China. Now, this is the story that we've been following for a pretty long time. China's asking CITIC to examine finances of shadow bank Zhongrong. Again, there have been a number of policymakers putting in place a number of things to try and support the consumer over in China. Unclear whether it will give a boost to consumer sentiment in China. And then some of the biggest concerns are retail with, of course, property, and then the shadow banking, as we've seen in Europe. So we're now seeing the first step from the government to try and deal with shadow banking, or at least look at what's inside some of these shadow banking financial services. Now let's get back to our big story of the day, which is European inflation. And let's get to Jana Rando in Frankfurt. Jana, what are your thoughts on the German inflation numbers this morning? How much does it complicate the picture for the ECB? And good morning.
Good morning. Well, I didn't really expect a clear answer from inflation anyway, because after all, what can 1 month of inflation data tell you? But of course, what we're seeing is offering even fewer answers than I certainly had expected. We saw a much faster than anticipated increase in consumer prices in Germany's biggest, most populous state. The other ones that have come in at the top of the hour, they're slightly more in line with the estimates economists have in their books. But what that means, and that's what's really important, is that inflation in Germany will stay above 6%. And obviously that cannot be satisfactory to anyone. Inflation accelerated also in Spain. In France, it's expected to accelerate again. So a lot of bad news really for the ECB as it prepares for its upcoming meeting.
Yeah, and Jana, how difficult is it actually to be the ECB in this point of time, especially when we had that jobs number, changing the narrative at the margins for the Fed going forward? I mean, if you don't have a convergence, it makes it much harder, I guess, to fight monetary policy.
Yeah, I mean, certainly I wouldn't want their job at the moment. It is very complicated. You have an economy that is slowing down. You have inflation that is proving very stubborn. And you don't quite know how that last leg of policy transmission from that slowdown in the economy, from weaker demand, will actually filter into inflation, given that you have this tight labor market, that firms are retaining their employees. And so that makes it very complicated. The one thing that policymakers still are waiting for are updated forecasts, so they might actually help them find answers to those very questions. They are in the process of being compiled at the moment, so we don't know what they are going to show. But my hunch is they're not gonna have clear answers either. So what we listening to policymakers over the past days, what seems to be emerging is a leaning among the hawkish community in the governing council to go for that final hike or that one more hike in September, take the deposit rate to 4%, because they say we haven't conquered inflation yet. It's much safer for us to err on the side of doing too much and then being able to retreat rather than not doing enough. So. Market is pricing that at the moment as well. So that's where, what I would expect from this point of view.
Jana, thank you so much. Jana Rando there in Frankfurt. Now joining us to talk more about inflation figures and what we can expect from the Fed, HSBC Global Chief Economist Janet Henry. Janet, always great to have you on set, but especially on a day like today where there's so much inflation to try and understand. How much does this complicate the ECB's job going forward? Again, I know it's 1 month. I know it's a big economy, but it's really one of the leading ones. Could we have missed this inflation trend?
No, I actually think that it is a continuation of the trend. Okay. We can move on to the US, but actually inflation has been a lot stickier in the Eurozone, and what's different is that wage growth has been accelerating. One thing I would point to, the North Rhine-Westphalia figure was something of an outlier. Yeah. We've now had something from the other states that wasn't quite as scary, but we have been looking for another rate rise in September. We think that will be the peak. But the growth numbers are weak, the PMIs are weak, but we need to think about the fiscal side of things, which is a lot more supportive for the economy, and the ECB is aware of that. The risk is now one, arguably, of stagflation.
But so, Jana, what does that mean? So is it going to be communication? What's the biggest job right now for the ECB, especially when you have countries like Italy that are blaming everything on the central bank?
Well, I think, we had something of this kind of message at Jackson Hole. Yeah. Certainly from Lagarde and not just Lagarde, from Powell as well, about the risk of a persistently higher rate of inflation. We may have fallen from the peak. There are lots of structural factors out there, and the Eurozone has a particular issue regarding labour markets. Central banks always face pressures from governments. It's always easier to blame the central banks, but actually a lot of the fiscal support is coming from the governments, and not so much just national governments. In fact, our European economist published a piece this morning all about the recovery fund. Remember that? They haven't spent much of that yet. A lot of that is going to be feeding through into the economy over the course of the next few years.
So, Janet, when you look at it, I guess the ECB, is there a concern that they want the credibility so badly that they'll over tighten and then push basically what's the biggest mistake, right? If they hold off higher interest rates, or actually if they're too loose?
Well, this has been the risk, which is worse, the risk of doing too much or doing too little. We need to remember that central banks have one goal, and that is price stability, and that is their inflation credibility. Now, also the ECB has to ensure the sustainability of the euro, but therefore, given their primary mandate of price stability, the risk is always that they'll risk doing too much rather than too little, because they know how to now seemingly to revive inflation. The risk is that it stays persistently higher for a lot longer, and all of the implications of that continues to feed through onto the economy.
So when can you, with confidence, say that we've seen the price hikes that we've done in the last 12 months through to the real economy? It's unclear if the lagging time is 12 months, 18 months, or could actually take longer.
Well, monetary policy works with long and variable lags, and we always think about monetary policy impacting on the demand side of the economy. What does it mean for the labour market? What does it mean for consumer demand? And arguably, what does that mean globally through the export channel? But we need to consider the fiscal side, and we need to consider the supply side of the economy.
Yes.
And it's putting all of that together that the central banks are going to continue to struggle with. But it's not just a question of how many more hikes. We know we're close to the peak. Whether it's one more, two more, or no more, in all the major central banks, the question is how long do they have to stay high for, and how much will they eventually be cut? You know, financial markets always want this V-shaped recovery and 500 basis points on rates. We may never get there. It may just be at quite an extended period, and the rate cuts, when we get them, actually being remarkably modest.
But could you see a big differential between what the US and the Fed does and what the ECB needs to do going forward? Or again, we speak to traders this morning that say, look, this has muddied the waters because after the JOLTS data yesterday, they thought the Fed would do one thing, and now the global economy is looking about more patchy.
I think there is a difference between the US and the Eurozone, and a lot of it does relate to the labour market and to the wage data in particular. Now, we think that the Fed has peaked, but there is a chance, you know, and certainly don't expect a rate rise in September. Of course, there's a chance that they have to do one more. But yes, we have got some rate cuts in 2024 from the Fed. We've got nothing from the ECB, and we feel pretty certain that they will be raising rates in September.
Is this small cuts from the Fed? And again, when we hear central bankers in press conferences or in interviews, they're really at pains in reminding everyone that we're not going to go back to the zero bound.
Well, we're not on any plausible central scenario at the moment, but a lot can happen that you don't see. So, you know, I'm always very careful not to rule out anything, particularly if there were to be any risk of any kind of financial crisis.
Which is not in your base case.
Absolutely not in our base case. In fact, we've never been in the traditional recession camp. You know, the market was convinced it was going to be first half 23 recession, then convinced it was going to be second half 23 recession, and now it's going to be a 2024 recession. It's not going to be a traditional recession. It doesn't mean you can't have 2 or 3 years of extremely weak growth, well below trend, and it is a much more gradual adjustment. But don't just think about the demand side of the economy, the labour market weakening, slowing consumer demand. Consumer demand has been booming in the US. Of course it's going to slow, and slow markedly. But the speed with which it feeds through to inflation and the need for the Fed to cut aggressively, I think will take some time. So we have just very modest cuts in 2024.
Janet, thank you so much. Janet Henry, of course, stays with us, and we'll talk a little bit about China next. And then after that, we'll talk UK when we get the mortgage numbers. Stay with us. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, let's recap some of the breaking news that we had this hour. Bloomberg understands that China has asked 2 of the nation's biggest financial firms to examine the books of Zhongguang International, potentially paving the way for a state-led rescue of the troubled shadow lender. Meanwhile, Bloomberg has also learned that China's biggest banks are preparing to cut interest rates on existing mortgages and deposits as the latest state-directed measure to shore up economic growth. Well, still with us, HSBC Global Chief Economist Janet Henry. Janet, thank you so much for staying with us. When you look at China, what's their biggest concern? So is it retail? We're following, is it real estate actually? We're following all of the concerned defaults. And would it be letting bubble out of the system, or could we actually see a crash that could take the economy down with it?
I think the property sector is still the biggest concern. We know that there has to be some kind of deflation of the property bubble. We've seen that elsewhere in the world. We saw it in Japan, we saw it in Spain in various decades, and it's over what period and how you manage that deflation of the property bubble. And it's quite clear from the latest round of measures that they are going to do their utmost to avoid any kind of crash. We're not going back to a world where property drove over half of the GDP growth in the Chinese economy, but they don't want it to be so severe that it impacts on the rest of the economy. So I fully expect that we see another slew of measures. We've already seen them in recent days, further easing of policy, even allowing people that own a home, if they buy a second one, if they own it outright, they can be a first-time buyer on their mortgage for their new home. So that will feed through. But sorry, yeah.
Will they work, these measures? So we've seen every 4 days there's a new measure that's meant to boost the economy and support consumers.
Well, a lot depends on how it feeds through to the availability and the cost of funding, but also to confidence. And, of course, what happens in the labour market. There are still lots of people in China that do not own their own home, never mind their second or their third home, but don't own their first home, who want to. And if they feel confident about the future and they can find an available loan at a reasonable cost for what they are earning, then you can eventually get some kind of stabilisation. And also, you know, we know that there is going to be some kind of restructuring plan, a lot of it related to local government funding. How that can feed through to the economy. So I think this won't be the end of the measures. We will see more in order to manage that ongoing deflation and allow some stabilisation in the property market.
Shadow banking is one of the most difficult things to actually look into and see what kind of liabilities there are. With the measures that the Bloomberg scoop saying that China has asked two of the nation's biggest financial firms to examine the books of Zhang Rong, do you worry that they could be also on a cusp of some kind of financial event?
Well, I think it's something that probably can be managed. We know that whenever there are financial strains in an economy, often it's in the smaller banks. Obviously, we had what happened last September with the US banking system, or in the shadow banking system. That's always something that's harder to see what's going on underneath the hood. But these are massive financial institutions. So whether there's some kind of government-led or government-backed solution with the larger institutions taking over the banks, as of course what happened with the US banking system, that will be the interesting side to see. And then it's your usual options. You can restructure the debt, you can sell the assets, because it seems like they're not going to grow their way out of their problems at the moment.
Yeah, and there's so much actually bearishness on what the China economy is going through and will go through. How much does it impact the rest of the world?
Well, for commodity producers in particular, obviously it can impact quite negatively, but we also know that there are various geopolitical developments underway in the world regarding the BRICS and such like that are leading to new trading relationships. And some commodity prices are actually still being supported by China demand. You know, iron ore prices haven't been doing too badly. The oil price hasn't been too badly. You know, that's one of the things people missed in the European inflation numbers, that August petrol pump prices did go up. You know, the commodity price story is not clear-cut. We're used to one where global growth slows down, all commodity prices fall. Actually, we've got a different moving parts, and don't forget the weather. Even India's inflation surprised massively to the upside because of food. It still matters.
Janet, thank you so much. Janet Henry there from HSBC stays with us, and we'll talk a little bit later about the UK and mortgages. Also coming up, a big win for the crypto sector. More on the Grayscale SEC ruling next. This is Bloomberg. Welcome back, everyone, to Grayscale won a key legal battle in a push to launch a spot Bitcoin ETF. Now, the ruling actually brings the U.S. crypto industry one step closer to tapping billions of dollars from everyday investors. Well, Bloomberg's Kelly Lyons has the details.
Grayscale has moved closer to launching a spot-based Bitcoin ETF in the U.S. in what is potentially a watershed moment for the crypto industry. A D.C. Circuit Court handing them a victory when a 3-judge appellate panel overturned a decision by the SEC to block the ETF. They said in the ruling, this is a quote, "The denial of Grayscale's proposal was arbitrary and capricious because the commission failed to explain its different treatment of similar products. In the absence of a coherent explanation, this unlike regulatory treatment of products is unlawful." Basically, they're poking a hole in the SEC's argument that a futures Bitcoin ETF, which already has been approved in the U.S., should be treated differently than a spot-based product. That is something the SEC has said because of fraud and manipulation, and yet it doesn't seem that this court is buying that argument. Now, this is not to say that GBTC, the Grayscale Bitcoin Trust, is going to convert into a spot ETF tomorrow, but it is still a big moment in that direction. This now goes back to the SEC, and they do have some recourse here. The SEC, through a spokesperson, said in a statement to Bloomberg, "We are reviewing the court's decision to determine next steps," and they still could fight this. They could ask the full D.C. Circuit Court for a review. They have to do that within the next 45 days, though our litigation analyst here at Bloomberg Intelligence, Elliot Stein, has said he doesn't think that would yield any kind of different result. There is also the ongoing question about what this means for other spot Bitcoin ETF applications that have been filed. None have ever been approved in the U.S. to this point, but we have seen a wave of them recently from the likes of BlackRock, WisdomTree, Valkyrie, and others. And it's a question how this ruling in the D.C. Circuit Court on Tuesday makes a difference ultimately in the spot ETF race here in the U.S. In New York, Kaylee Lines, Bloomberg News.
And don't miss our interview coming up later today on Bloomberg Markets with the chief executive of Grayscale, Michael Songnonshine. That's at 3:45 p.m. London. That's 10:45 a.m. New York time. Coming up, we're watching the latest UK mortgage approvals. The data are due to land in the next few minutes. This is Bloomberg. A Bellwether German state actually posted a surprise CPI jump in August, suggesting the ECB may have more hikes ahead while Spanish inflation quickens again. The latest U.S. jobs and consumer data offer support to investors, speculating that the Fed is nearing the end of its tightening campaign. Plus, UK property portal Zoopla says home sales are on track to drop to the lowest in over a decade. We'll bring you the latest mortgage data very shortly. So good morning, everyone, and welcome back to The Pulse. I'm Francine Lacqua here in London. So we're talking UK home sales are on track to drop to the lowest in a decade this year. That's according to data from Zoopla. And the latest UK mortgage data is out any minute. Still with us, Janet Henry, Chief Global Economist at HSBC. Janet, if the ECB and the Fed have it tough, the Bank of England may have it tougher because of the tight labor market. That's tight. I mean, it's harder to get people back into work here than anywhere else. Are we giving the UK too hard a time? Do you think it could actually surprise to the upside?
Well, the labour market is a particular issue in the UK. We have seen some improvement in the participation rate, but nothing like we've seen in the US or France or Germany. We have this particular problem with inactivity. But we did, in the last labour market release, see the early signs that the labour market was softening. And as labour markets soften, you see less churn. Like we saw in the US, the quits rate actually fell back, the jolts rate has fallen back. And that's where you get the wage growth. It's when people change jobs rather than getting an 8 or 10% pay rise in their current job. So that's the early signs that if that feeds through, we may see some softening on inflation. But the UK has got the particular supply issues that the rest of the world has got, but also Brexit related. And together with the labour market issue, it's got, different parts of the economy are more resilient than others. Parts of the economy have been in recession for some time. Parts of the economy remain more resilient. It's just not really growing.
Janet, we're also getting some UK July mortgage approvals. There are 49,444. The estimate was 51,000. So it's a touch below. It's a touch below. It's 49.9. Do you worry about the housing market in particular? If you look at all of the data points out of the UK, what worries you the most?
Well, when interest rates rise, anyone dependent on leverage feels the pain.
Yeah.
And, the UK housing market is particularly interesting because of the whole population, about a third of people don't have mortgages because they own their own home. A third of people don't have mortgages because they're renters. And a third of people have got mortgages and they're what's feeling the pain. But the lags will feed through. And this is the challenge the central banks obviously face. How much higher do you have to go rather than how much do you have to keep it at these levels? But we know in the UK mortgage market, the market's still quite tight. There's not enough houses on the market. How
much higher do you think the BOE will go? The language I thought was striking in the last press conference because it mirrored what the ECB was saying.
It was, but the UK is more sensitive to short-term interest rates than the majority of the Eurozone. You know, in France and Germany, when people, you know, take out a 20 or 30-year mortgage, you know, a lot of them have still got their 1.5% mortgage rates for the next 30 years. It doesn't work that way in the UK. 5-year fixes are more important, and that has provided some insulation for certain people against these rate rises, so it will feed through. So on the Bank of England, it's very similar to our ECB view, actually. One more rate rise at the next meeting, but rates on hold for quite an extended period, no rate cuts next year.
What does it mean for the mortgage market and for house prices? Could we see a crash?
I think it's unlikely that we see a crash, just given that supply-demand imbalance. Okay. There are few in the way of forced sellers. And until you see a significant rise in unemployment, so that would be the trigger. You know, we wouldn't get a property crash unless we were to see quite a significant rise in unemployment of mortgage holders.
Janet, when you look at currencies, and I don't know whether sterling could be supportive or not, I mean, there's quite a lot going on also in UK politics that then translates into economic policy. How do you navigate that?
Well, I think that the currency, obviously sterling has rallied from its lows, and it's been pretty stable within a tight range against the euro. So actually, I think as much as, you know, changes in relative interest rate expectations will to some extent matter for sterling, a lot of it I still think will be something to do with the cross rate between euro-dollar rather than something independent in the UK.
So overall, are you confident? I mean, we could also see a change in politics. So without talking about the politics, is, I guess, the economic agenda more uncertain here because we could see a change in government at the next elections?
We could. But remember, we've got elections in a lot of places. By the end of 2024, we could have a different administration in the US as well. But regarding investment spending and expectations regarding whether it's something to do with wealth taxes or income taxes and such like, that can affect consumers' decisions and indeed company decisions.
The BOJ, we haven't talked about the BOJ. It's probably the most interesting one out there. I mean, is there a question mark on whether the BOJ will have to get in line with all the other big central banks, or whether actually 2 years from now it'll be the other way?
I think Japan has already been quite fascinating. You know, in a world where all the major central banks have been grappling against much higher than expected inflation, Japan is the one country that's celebrating the fact that after 3 decades they might be getting out of deflation. And we obviously have seen some significant modifications in terms of yield curve control. Some people have argued that's played a role in the rise in US bond yields. I think more it's been the strength of the US economy and indeed some fiscal concerns that's driven that. For Japan, if the recovery continues and the labour market side data, it does firm through in terms of wage growth and core inflation does continue to rise, that's when I think you'd see some global implications of it. But a lot needs to go right for Japan to actually be raising interest rates over the course of the next year or just more.
Janet, thank you so much, as always, for joining us. That was Janet Henry, Global Chief Economist at HSBC. Now, let's also go back to some of the latest China data that we've seen. Actually, this is ICBC coming in. We also have Bank of China. So this is 2 big financials. ICBC, that's first half net income coming in at 173 billion yuan. Now, this means that year on year, it's up 1.2%. We also have Bank of China, that net income is up 0.8%. year on year. So we'll be covering all things China. We'll also be covering all things UK, and that's a little bit later on in the week. We'll have plenty more on China, including our Bloomberg scoop saying that China has asked 2 of the nation's biggest financial firms to examine the books of Zhongrong International, potentially paving the way then for a state-led rescue of the troubled shadow lender. That's according to people familiar with the matter. So Bloomberg scoop, and we'll have plenty more on that next. This is Bloomberg.
All eyes are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, the British Foreign Secretary, James Cleverly, is visiting Beijing today. He urges China to help bring Russia's war in Ukraine to end as he tries to mend the UK's ties with the world's second largest economy. Now, let's bring in Bloomberg's Sofia Ortega-Costa. More on the politics shortly, but first, we also got some pretty big headlines, Sofia, on, of course, the China asking the biggest financial firms to look at shadow banking. Is this alarm bell? Should we be concerned about this?
This is an important step. It does seem like Beijing is looking to perhaps lead a state-backed rescue of this shadow bank. So what essentially happened is shadow banks, they're the alternative funding source for not just developers, but for companies that can't get loans via banks because the lending conditions are so strict in China. So the concern is that there could be a cascade of financial risk if we do get this company collapsing in a disorderly fashion. So the fact that CITIC and CCB Trust, two companies that are linked to state-backed lenders, are looking at the finances of this shadow bank suggests that the same that happened to China Huarong, the bad debt manager in 2021, could also happen to this shadow banking. So what this tells me, Fran, is that authorities are kind of tightening their grip and also increasingly concerned that this could spill over to the rest of the financial system.
But is it something that they can manage, or could we see a significant financial event? Again, shadow banking is one of the trickiest things to get a handle on, probably one of the most dangerous if it unravels.
Yes, exactly. And the problem is that it's not entirely clear how big it is. There are estimates over the size of the shadow banking sector, and China has cracked down on it in recent years and made it smaller because of the spillover risks to the financial system. China did handle the Huarong crisis quite well, and there wasn't a spillover back then. Actually, it was almost a poster child of how to do a state-backed restructuring and bailout. It was a big one back then. So if they follow the same playbook and the restructuring follows through in the same way that it did, then it could be positive. I mean, you do want the state, you do want Beijing to kind of take charge here because of the risks that it poses to the economy in general.
So, Sophia, let's also talk about the politics, but first let's hear from the UK Foreign Secretary, James Cleverly, who is also in China. Here he is.
Well, my visit here is about the bilateral relationship between the UK and China. In my meetings, both here and in previous meetings in the UK, I have said that Russia's brutal invasion of Ukraine cannot be justified by Moscow or indeed anywhere else.
So we have the UK Foreign Secretary there at the moment. We have the US Commerce Secretary also in Shanghai. Is this a general push from the West to go to China for friendlier ties, and what do they need from China?
I think that's a really important question, Fran. And how the Commerce Secretary, the US Commerce Secretary, Gina Raimondo, separated the two things. One is diplomacy and how both the UK and the US are pressuring China, especially on the Russia-Ukraine war front, but also Taiwan, Hong Kong, a lot of interest there. That's one thing. And I think there's hawks back at home, China hawks, who really want that pressure to continue. And the other side of things, and this has been very important that both the US and the UK say these are two separate things, is economic ties. Right. So strengthening those ties, that can coexist essentially with more pressure on the diplomatic side of things. And I think that's where the messaging is right now, because it is important for the UK, especially following Brexit, to show that there are benefits to leaving the European Union, and one of them is to renegotiate on the trade front and to kind of have a little bit more control over that China economic relationship, Fran.
So what's your take on the Foreign Secretary, James Cleverly? What was his welcome like? I know a lot of the times it's about the body language. Do they welcome the UK more than the US?
I think the US meeting from the China perspective is more important.
Yep.
It did open the door for the UK meeting, and I think there's a perception in Beijing that the UK does whatever the US says. I'm sure the UK would have its own response to that. But it was a warm welcome. I mean, this is a time when authorities in Beijing are seeking to re-engage more with the West. After 3 years of essentially being closed and pursuing this isolationist policy, there's a lot of domestic issues that China is going through right now and is dealing with, not least with the property market. But re-engaging with the West and projecting this kind of more business-friendly approach is a very, very important step towards attracting foreign investment. So I'm sure he was warmly welcomed, Fran.
When you look at, the big news is also that Vladimir Putin is going to China. Is that, I don't know how China handles that.
I think that's a really important question, Fran. And this is a time when Beijing authorities in Beijing are seeking to re-engage more with the West. After 3 years of essentially being closed and pursuing this isolationist policy, there's a lot of domestic issues that China is going through right now and is dealing with, not least with the property market. But re-engaging with the West and projecting this kind of more business-friendly approach is a very, very important step towards attracting foreign investment. So I'm sure he was warmly welcomed, Fran.
When you look at, the big news is also that Vladimir Putin is going to China. Is that, I don't know how China handles that.
And exactly, I mean, cleverly said that no nation should legitimize Putin, and clearly China's support of Putin, diplomatic support, you know, not really the kind of support that would concern the US and the UK quite yet. But how will China welcome Putin, and how will it position itself with this visit? The last time Putin visited China was 3 weeks before Russia invaded Ukraine, widely perceived to be kind of a surprise for China at the time, because it was when Xi and Putin declared this kind of no-limits friendship. So how will China position itself here? Will it be a neutral actor, try to end the war? That's how it's been trying to project itself in the recent months. Or will we again get a kind of closer relationship between the two countries that could potentially worry the US and the UK?
Sophia, thank you so much as always. Sophia Ortega-Costa there with the very latest on China, both the politics but also the economics. Now coming up, airlines scrambling to recover from the biggest aviation outage in the UK for a decade. We'll have our reporter here with me in the studio. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, we're just getting some breaking news out of Gina Raimondo, the Commerce Secretary. She's speaking actually in China at a Boeing factory. And she did say just 24 hours ago that U.S. companies have been telling her that China is becoming increasingly uninvestable because of growing risks to doing business in the world's second largest economy. So we'll see exactly what she continues saying. The comments, of course, from the top trade promoter underscore that commerce has become one of the main strands of tension between the U.S. and China, even as she and Chinese officials that she met last week seem to stress that the economic ties are key to sustaining a working relationship. So we'll see, of course, from her comments and her body language what that will lead to. Now, China Airlines is planning to boost its fleet with more fuel-efficient aircraft as part of its sustainability push. The president of Taiwan's main carrier tells Bloomberg that the airline is looking for a new balance between cargo and passenger in the post-COVID times.
We are coming back. We are coming back. The passenger is about the 50% same volume compared with the 2019 pre-COVID. And for the first half, 2023. But right now, we are looking for the very significant increasing at the second half. We will have the 70% to 80% coming back compared with the pre-COVID. And we are very confident about this increasement.
When do you think you'll get back to pre-pandemic levels?
According to the IATA forecast, probably need to wait until 2025.
We saw cargo demand was boosted, and it in some ways really did save your airline during the pandemic. In fact, you made nearly record revenue during 2021. That sort of trend is reversing now, and cargo demand is stabilizing. Where do you see the bottom? Where is that going to settle?
I would say that the demand of the cargo is not as high as before, and but we will try to find a new balance, which is not the sports shoes. The new balance between the cargo and the passenger. And so we will try to find out how many percentage we needed focus, put the capital in the cargo.
So what is that new balance? What is the right mix between passenger and cargo now, you think?
We're still looking for that, because that need to be dynamically evaluation for that. But probably go back to the before 2019, it's about the 30 to 70% ratio.
The China Airlines president speaking exclusively to Yvonne Aman. Now, airlines are rushing to restore flight operations in the UK and repatriate stranded passengers after the worst air traffic outage in a decade. Returning to normal service could take several days after hundreds of delays and cancellations on one of the busiest days this travel season. Let's bring in Bloomberg Sid Phillip. Sid, I go to you all the time, say, is my flight going to be delayed? And you say, keep cool, maybe, maybe not, because exactly, you know, of what happened on Monday. First of all, what do we know, and how long does it take for flights to readjust their paths?
Yeah, so what we know so far is that the NATS, which is responsible for airspace control in the UK, has said that a piece of incorrect data is responsible for the system shutting down, and it was part of an automatic process to prevent the system from having any further issues. And that really caused an outage that affected more than a quarter of flights coming in and going out of the UK, hundreds and hundreds of cancellations and delays. And so it's really, the airline industry has to now bring back their sort of aircraft, bring back crews and sort of restore operations. And because of the cancellations and delays, aircraft that should have been in one place are in another place, and crews are out of hours. And because of that, it takes a while to rebuild operations. And so we have seen sort of continued cancellations, but obviously at a smaller volume than on Monday, really.
So how long does it take usually? And do they, try and safeguard the long-haul flights and actually prefer the impact on the more short-haul flights? Do we know how much this would cost some of these airlines?
We don't yet have an estimate on the cost, and NATS has said that they're going to put out a preliminary report on what really happened on Monday. And so we have to see what the causes were. But in terms of the impact on airlines, I mean, this is the busiest travel season of the year. And so there's very little slack capacity in the system in order to sort of repatriate passengers, put people on alternative flights, sort of run extra flights. And that's really causing issues in terms of people being stranded. It's also causing issues in terms of airlines not being able to redeploy aircraft on the route. And the reason why short haul was more impacted is because especially on some routes where there's multiple frequencies, airlines can sort of afford to be able to reroute people or sort of combine flights, whereas long haul typically tend to be much longer in terms of duration, and so aircraft need to be in position, and that's why they prioritize long haul versus short haul.
And said at the same time, the Ryanair chief executive pulled no punches.
Yeah, I mean, airline CEOs are furious. I mean, there's no doubt about it. And especially, I mean, IATA has been talking about how how can a single piece of data cause the entire system to shut down. And there will be sort of questions that airline CEOs bring towards both the government and NATS in terms of the resilience of the system and the fact that it failed at what is the busiest time of the year, and the cascading impact on the airlines in terms of having to compensate people not by way of financial compensation, but having to accommodate them in hotels and rebook them and offer them. So it's essentially the airlines are having to pick up the brunt of the expenses for this outage.
Sid, thank you so much, as always, for the terrific briefing. Our Bloomberg Global Aviation senior reporter, Siddharth Philip. Now, meanwhile, Bloomberg has also learned that Lufthansa is looking to sell its insurance brokerage unit, Albatross, and insurance business, Delvag, as it pushes to streamline operations. Now, the German airline has been selling non-core businesses in the bid to raise cash as it focuses on consolidating Europe's aviation market. And UBS expected to report its second quarter results tomorrow before a cash trade starting in Europe. I'll be sitting down with the Chief Executive, Sergio Armotti. So what's the latest on the headcount and Credit Suisse's Swiss bank unit? There's a lot of questions that hopefully we'll have answered when they also report earnings tomorrow morning. So don't miss our interview, 7 a.m. London time, that's 2 a.m. in New York. Up next, Bloomberg Surveillance Early Edition with Simon Foxman in New York and Danny Berger here in London. And this is Bloomberg.